It's not being recorded.
Assembly. Hey. But we started from the translation, right? And we spoke about convenience one in the first one. So we start with the translation. Nothing will
No, the
happen.
goodwill, it didn't record.
And all these ones I didn't record. But
Yes.
since you people you are here, you can remember. Don't worry. The problem is the workings. But me too, I've
For
forgotten.
revision.
Hey.
But it's very important for the videos.
Yes, but this one they are forgotten. My family people are worrying me. Don't worry. We are very fine. All right. So the exchange gains or losses on translation. What will happen is that exchange difference or net asset arising as a opening net asset are initially translated at the opening rate. The comprehensive income for the year, movement on net assets will have been translated at the average rate. And the closing net asset on the statement of financial position are then translated at the closing rate. So you can see that the closing net asset is just the opening net asset plus the profit for the year. That forms the closing net asset. But the opening net assets are translated at opening rates. The profit for the year are translated at what? Average rate. But at the end of the year, we are translating both at a closing rate. It means that there will be a difference in the rate. But if the opening and the average rate and the closing rate are the same, there won't be any gain on it. But if they are not the same, there will be a gain. Exchange difference on goodwill will have been previously translated at the current year's opening rate, the previous year's closing rate, and any impairment in the year will be translated at average rate in the statement of profit or loss, and the year-end goodwill is then translated at the closing rate in the statement of financial position. What you have to know is that all things being equal, if the rates are the same at the beginning, average are the same, average is the same as the beginning, and it's the same as the closing rate, we are not going to have any issue about again. But when the exchange rate at the beginning, the average one, they are all different. The closing one too is different. It means that there will be a loss or there will be a gain because the rates are not the same. The exchange rates are not the same. All right. The sum of the two exchange differences is recognized with other comprehensive income. This is not a normal exchange loss that we will go and send to statement of profit or loss. Normal exchange loss will be sent to statement of profit or loss. But exchange gains or losses on translation of subsidiary will be treated in other comprehensive income. The group share of this foreign exchange difference will be held in a separate reserve within equity in the statement of financial position. So what we do is that if at the end of the day, the exchange rate is 3,000 and the parent is having 70% control and the NCI, non-controlling interest, which was formerly called minority interest, is 30%. How much would the parent be receiving in their proportion?
1,100.
It will be receiving
2,100.
2,100. And the NCI will be taking what? 900.
900.
Don't send this to retain earnings of the parent. Don't send it to group retain earnings of the parent. It will be shown as other reserve or other component of equity in the statement of financial position for the parents. Okay. Let's move on.
Please take that again.
I'm saying that this particular exchange difference gain, don't send it to statement, don't send it to retain earnings of the parent or the group retain earnings of the parent. It will be sent to other reserves or other component of equity for the parent, which will be shown as an equity item in the statement of financial position. The gain is not part of our ordinary business activities. The only thing that will go to retain earnings are those gains or those profit that are arising from our day-to-day activities. The exchange gain is not something that we do. It's not part of our ordinary business activity. So it will be held in a different accounts, other components of equity or other reserves. Are we there? Upon disposal of the subsidiary, the balance on this reserve will be recycled true profit or loss to form part of the total gain or loss on the disposal of the subsidiary. So if in any case you have disposed of the subsidiary, it means that the subsidiary is not there. So the gain can also not be there because it is relating to the subsidiary. Since the subsidiary is no more there, the gain will be reclassified. We are going to send it to retained earnings now. So the gain can only be transferred to retained earnings when you dispose of the subsidiary. All right. The exchange difference on net asset is always split between parent and NCI based on the group shareholding. That is at 70 and then the 30%. The treatment of the goodwill exchange difference depends upon the method used for valuing NCI and therefore should be considered separately. We have two ways of measuring the NCI. If at the end of the day, is someone calling me?
No.
Okay. If at the end of the day, they are saying that the total value of the parent is 50,000, the total value of the subsidiary is 50,000, the parent is buying 70%. NCI will be having what? 30%. What will be the parent portion of the value of the subsidiary based on the shareholding? What will be the parent share of the value of the subsidiary based on their shareholding? What will be the value? The total value of the subsidiary is 50,000. Parent is having 70. What will be the value for the parent?
35,000.
35,000. Subsidiary will be what?
15,000.
Okay. If you are doing this to find their value, we say that you are using what we call partial goodwill method. Partial goodwill method makes the subsidiary saying that just give me my portion of the physical items that I can see. The physical items are those values of the subsidiary, their assets and those things. Just give me the share of the physical items that I can see. I don't want a share of the invisible item that you are seeing. Me, I don't want a share. Just give me the share of the physical items. That is what we call the partial goodwill method. But if they are saying that the fair value, the company is using the fair value, and the fair value of the NCI at the date of acquisition is 18,000. It means that NCI is receiving how much in excess? How much are they receiving in excess?
3,000.
They are receiving 3,000, and this 3,000, they are also receiving the physical asset and also receiving the share of the invisible item that they can't see. So they are also having a share of a goodwill, which is 3,000. So goodwill now is 3,000 because under normal circumstance, their share should have been 15,000, but they are now receiving 18,000. It means that they are receiving amounts in excess by 3,000. That 3,000 represents their share of the goodwill. So if you're using fair value method, it means that whenever the goodwill impairs, it means that their 3,000 will also impair. So you have to share the goodwill and give them their portion. So if you're using partial goodwill method, where the NCA will have the share of only the physical items, the goodwill is for the parent alone. NCA is not having portion. So if there is a gain on the goodwill, it is the parent that will take it. But if the NCA is having the physical portion and the intangible portion, then if there is a gain on the goodwill, you will now share it among the NCA and then the parent in their proportion. All right. They say you should have approach to a question. I don't know which approach they are talking about. Okay. Basically, this is how we calculate the gain on a net asset. We can calculate the gain on a net asset using this. We use a closing net asset at closing rate. We translate it. Then we less the net asset at opening rate, and we also less the profit for the year at an average rate. This means that under not all things being equal, our net asset should have been the net asset at the beginning plus the profit for the year. So if you do this, you add, that should have been it. But if you are translating at a closing rate, what is the value now? Then you compare, you have your gain. Let's count to the goodwill. Goodwill, closing goodwill at a closing rate. Then you less opening goodwill at opening rate. Then you add back impairment for the year. What does that mean? Okay. Let's come here. Assuming our opening net assets. Our opening net assets, if you translate it, was 20,000. Our profit for the year, if you translate it, will be 15,000. Under normal circumstance, our closing net assets should have been what? 35,000. But after translating the closing net assets, they are now saying that the closing net asset is now 40,000. What is happening? Under normal circumstance, should have been 35,000, but it's now what? 40,000. What is happening?
Yes, again.
It has increased by 5,000. That increase is the exchange gain that we are talking about. It is the exchange gain that we are talking about. All right. So another way, the goodwill one too is that goodwill at opening is 15,000. During the year, there was impairment of goodwill. And that impairment was 2,000. What should have been the goodwill figure at reporting?
13,000.
13,000.
13,000. So they are now saying that the closing rate, the closing goodwill is now 15,000. What is happening?
It's again.
There's a gain of what? 2,000.
2,000.
That's why the question is saying that, look at this. That's why the question is saying that you have the closing goodwill. The closing goodwill is what? 15,000. Then you now less what? The opening goodwill. What is the opening goodwill? 15,000. Then you now add the impairment, because the impairment should have been subtracted from the 15,000 before we less. But we didn't subtract, so we add. That's what they are saying. So if you like, you can subtract the impairment from the opening before you compare the figure with the closing. Then you find this one. Or you can add the impairment back to the closing before you subtract the total opening, because the impairment is part of the opening. So you add back anyhow you want to do it. All right. Let's pick a question. Let's pick one question, then we solve it. Then we see what we do. We solve only statement of financial position today. And next time we do statement of financial position and closing on Saturday. Let's look at question 4. Please, who has been reading for us? The person is not there. Oh, Richard is not there. Richard is gone. Oh, assembly. Auntie Joyce, can you read for us?
Okay. On 1st July 2021, Paint acquired 60% of Brush, whose functional currency is DS. The presentation currency on the Paint group is the dollar. The financial statements of both entities are as follows. Statement of financial position. The following, or I should read through.
Just leave it. Let's move on to the
Okay.
additional information.
The following information is applicable. A. I can't see. Paint purchased the shares in Brush for $10,000 on the first day of the accounting period. At the date of acquisition, the retained earnings of Brush were 500. The fair value of Brush net asset exceeded the carrying amount by 1,000. This fair value adjustment was attributable to plant with a remaining 5-year life as the date of acquisition. B. Just before the year end, Paint acquired some goods from a third party at a cost of $800, which is sold to Brush for cash at a markup of 50%. At the reporting date, all these goods remain in the inventories of Brush. On 1st June 2022, Paint lent Brush $1,400. The liability is recorded at the historic rate within the non-current liabilities of Brush. Paint measured non-controlling interest at acquisition at fair value. The fair value of the non-controlling interest in Brush at the date of acquisition was 5,000. An impairment review was performed, and goodwill had reduced in value by 10% at 30th June 2022. On 1st July 2021, Paint received a government grant for $4,000. This grant was provided as a contribution towards the cost of training employees over the next 2 years. Paint has reduced its administrative expenses by the full 4,000. Exchange rates are as follows. 1st July 2021, 1D. Okay. Please, I don't get it. D is to $1.
I mean, on this one, the Brush functional currency is the D.
Okay.
All right.
Okay, so 1st July is 2 is to $1. Average rate 3 is to
3 is to 1. Yeah. Yeah.
And then 30th June 2022, 4 is to 1. Prepare the consolidated statement of financial position for Paint as at 30th June 2022.
Okay. So this is the question. Before you think about anything, go and put your statement of financial position there. So this will be question 4. Before you start thinking about anything, go and put your uncompleted statement of financial position there. So we have question 4. We had a question 4, which will be statement of, okay, consolidated statement of, or you can put it Paint Group statement of Paint Group consolidated statement of financial.
Sir, please, are you writing something?
Yes, you can hear me. You can see.
Yes.
Sorry. Okay, question 4. Then you put at the top Paint Group. Paint Group consolidated statement of financial position as at the date. You put a date there. Then the first thing is that you start with the non-current assets. Non-current assets. And the first one is what? What is the first non-current asset there?
PPE.
Okay. the investment in Brush will not come. That is the amount that we paid for them. So we will cancel their shares with the investment. So that will not come. The loan to Brush, that is a loan given to them, but we cancel it at the end. So let's write the loan there first. Let's write the loan because we are going to cancel it. That is intra-group transaction. What is the loan amount?
1,400.
So you just put it in brackets. Let's come to the next one. What is the next item? PPE. PPE will be, the parent one is what?
10,000.
10,000. The subsidiary own, we translate it. So it will be 15,400. Is it going to be division or multiplication? Let's go. We are preparing this at
Let's
30th June. So
the
we use the 4.0. Okay. If 1D if 1D is equal to 4, okay, so it means that 4D is equal to $1, isn't it? So if 4D is equal to $1, how many dollars will be 15,400 be equal to? Is it going to be division or multiplication? Division or multiplication?
Division.
Minus
Division.
all the things you said, we didn't hear.
Okay, I'm saying that this one is 4D is $1. 4D is $1, but we are having 15,400 D now. So I'm saying that if 4D is $1, $15,400 will be how many? So are we dividing or we are multiplying?
We are dividing.
We are
Right.
dividing. Okay. So this will now be divided by 4.0. So you leave it open like that. Let's come to the next one. What is the next item there? Okay, this one, they just put asset there. So you to group it like that, assets. Don't do anything like non-current asset. Just put all of them together. The next one is what?
Inventories.
Inventories. Okay. So we have the inventories. The parent is how much?
5,000,
5,000 plus
4,000.
plus 4,000. They say something about inventory. Let me check if it will affect the subsidiaries own. Just before the year, Paint acquired some goods at a cost of this, which it sold to Brush for cash at a markup of this. At the reporting date, all these goods remain in the inventory of Brush. Okay. 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 This will affect the Brush inventory. So let's pick the 4,000 there. I will come and explain why we will adjust it. It means that just before the year end, so that just before the year end, Paint acquired some goods from a third party at a cost of 800, which it sold to Brush for a cash at a markup of 50%. At reporting date, all these goods remain in the inventory. So it means that included in the inventory of Brush, the parent is giving them these goods to sell. So what will happen is that that is not a cell. It's supposed not to be a cell. So we assume that the goods are still with the parent. So we remove it from the brush inventory before we translate it, because that is not a cell. They didn't buy the goods. It's the parent that gave it to them. So we can't translate something that belongs to us. So we take it before we translate this. Let's be good. If you get there, I will show you what I'm talking about. Let's move on. So we have receivables. Receivables is how much? 4,000 plus 500 divided by 4.0. The next one is cash. Cash and cash equivalents. Let's just put cash there. That will be 1,600 plus
500.
560 divided by 4.0. Okay. Let's leave space like 4. Then we come to equity and liabilities. Equity and liabilities. So the first one, we have the equity capital. The equity capital. The equity capital we use only in the parent. We use only in the parent because we are going to cancel the subsidiaries owned with the investment made. So we use only the parent equity capital unless there is share exchange. So we have 10,000. The next one is revaluation reserves. The revaluation reserve, the one that will count will be only the parent owned. The revaluation reserve that will come will be the only the parent owned, because the subsidiary owned will be shared among the parents and the NCI. So we have the revaluation reserves. So for the equity items, we bring only the parent owned. So this will be changed to group retained earnings. Then we are going to bring non-controlling interest here, which is the NCI. NCI. We are going to do workings for that. So we leave space. Then we now come to non-current assets. Then we also come to current assets. So non-current assets, there is some issue about loan over there. So I will do only the parent own 5,000 plus the subsidiary. I'll just put the figure there because there's some issue about loan over there. So I'll come to current liabilities. I'll have,
Hello, sir.
yeah.
Sorry to cut you. Please, what are we treating?
What are we treating?
Yes, please.
As in,
The topic.
do you have the notes?
Yes, please.
What is on the notes?
The effects of changes in foreign exchange.
Is that how the notes is titled?
IAS 21.
No, the note is foreign subsidiary. That is the title of the notes.
Okay.
Okay, so under the foreign subsidiary, you have to understand the IAS 21.
Okay.
All right. Are you okay now? Okay.
Yes.
Okay, let me start with the workings now. Let's start with the workings. Let's take the additional informations one by one. And we see what will happen. Let's take the additional information one by one and see what the Holy Spirit will do. Workings. The first workings that you have to do is to tell us about the group structure. You have to tell us about the group structure of the company. Okay. What is the group structure?
60-40.
So the parent is having what?
60.
60%. And NCI is what? 40%. The total will give us what? 100. So you tell us about the group structure. The next thing is you have to tell us about the acquisition date. What is the acquisition date? When was the subsidiary acquired? Acquisition date.
1st July 2021.
So acquisition date is July 1, 2021. Then you tell us the reporting date. What is the reporting date?
30th June 2022.
30th June
2022.
2022. Okay. 30th June 30th, 2022. So what is the post-acquisition period? For how many? Post-acquisition period is the number of years that the parent has control over the subsidiary. How many years?
1 year.
One.
1 year. Okay. After this, some people, what you are familiar with is the net asset method. I don't want to confuse anyone. So I will do the net asset method for you. The net asset method, what we are doing is that we want to know the value of the subsidiary at the date of acquisition. And we also have to know the value at the reporting so that we can find our profit for the year. So the next thing is to show the net asset method. The net asset of the subsidiary. So the net asset of the subsidiary, we show it at acquisition. And we also show it at reporting. The basic understanding of this is to know the value of the subsidiary at acquisition and also the value at the end. The difference between the two is the profit, because the net asset at acquisition will only increase by profit. So we look at this. Then we start with the share capital. The net asset that we are looking for. The net asset, the definition of net asset under console is total asset minus total liabilities. It's not the one that we know as total asset minus current liabilities. No. The net asset under this is we are looking for the value of the company which relate to the ordinary shareholders. So we are looking for the value of the company which relate to the ordinary shareholders. So if there is preference shares, we subtract it from the total asset because we are looking for the owner's value, not the total funds in the business. So we are looking for the owner's value. So we take the equity shares of the subsidiary. What is the equity shares? What is the equity capital?
$1,000.
Okay. What happened is that we assume that there is no additional issue of shares during the year. So the value that they have at the beginning is the same value that they have at the end. But for retained earnings, the question will always give you something about retained earnings for the year and retained earnings at acquisition, because the figure over here, their retained earnings over here is the one at the beginning plus the profit for the year. So they have to tell us which which part of this is at the beginning and which part of this represents the profit for the year. So the additional information will always give you that. Let's look at this. Paint purchased the shares in Brush for 100,000 on the first day of the accounting period. At the date of acquisition, the retained earnings of Brush were what? 500. So at acquisition, what were their retained earnings? 500. At reporting, then you now come and pick the retained earnings figure in the statement of financial position. How much is that?
12,500.
So it means during the year they made a profit of how much?
12,000.
12,000. Exactly. Let's come here. So at the date of acquisition, the retained earnings of Brush were 500. The fair value of Brush net asset exceeds the carrying amount by 100. This fair value adjustment was attributed to plant within a remaining life, with a remaining 5-year life as at the date of acquisition. They didn't say anything about their revaluation reserve. Let's see. They didn't say anything about the revaluation reserve. Okay. All right. Since they are not saying anything about the revaluation reserve at the beginning, we assume that the revaluation reserve is at what? Is after post-acquisition period. They have the revaluation reserve after their parent has acquired them. So they don't have any balance on the revaluation reserve at the time that their parent is buying them, because they didn't say anything about it. So you assume that that is after acquisition. So there is no revaluation reserve on the account at acquisition. So what will happen is that at the date of the acquisition, some of the assets of the subsidiary might be increasing and some of them might be reducing. What we do is that we now find their fair value. What are they saying? They are saying that Paint purchased the shares in Brush for 50 and this. The fair value of Brush net assets exceed their carrying amount by what? 1,000. What is the meaning of this?
Revaluation increase.
So if our asset is increasing, it means that this particular value was not added to the assets. So now that we are going to add it, what will be the effect of increasing asset on net assets? If asset is increasing, will equity also increase? If asset is increasing, will the equity value also increase?
Yes, I think so.
Yes.
Yes.
Yes, it's supposed to increase
Really.
because
Yes, will increase.
the asset will increase that by that amount, but liability will not increase. We
No.
still subtract the same liability from the new
No.
value now, and the equity will be increasing.
Mm,
So if there is fair value increase, we add it to the net asset, because the asset is going to increase. The same liability will be subtracted from the same amount. It means that the equity will also increase by the same increase in the asset, which will be 1,000. So we assume that this will also be 1,000. So what will happen? The asset that they have in the statement of financial position, did they consider the 1,000 before recognizing the 15,400? Was the 1,000 part of the 15,400? The 1,000 over there, was it part of the 15,400?
No.
No, because they are not aware. So what are they going to do now? They will now come and what? Add. They will now come and add to increase the asset, because the value of the asset has increased by that. But what happens? They say that the fair value adjustment was attributed to plant with a remaining life of what? 5 years at the date of acquisition. The acquisition date was what? July 1, isn't it?
Okay.
July 1. At 30th June, would the asset still be having 5 years?
No.
What will happen? It will be having 4 years. It means that the asset will depreciate by what?
1 year.
1 year. So let's calculate the depreciation. It will be 1,000 divided by what? 5.
5.
That will give us how much?
200.
This depreciation should have been subtracted from their profit, but have they done that?
No.
No.
But where can we, under the net
So
asset,
we'll pull it out of there.
under the net asset, where can we see depreciation? Where can we see profit? Where is the profit for the year under the net asset
At
now?
reporting.
Reporting.
So the depreciation should have been subtracted from the profit, and the profit is at reporting. So we subtract the depreciation from the reporting, because that is where the profit is. So I'll put 0 here, then I'll come and subtract what? 200 over here. Would the asset value be 10,000 again? Would the asset value be 1,000 again?
No.
No, it
No,
means that we
we are
have to come and
supposed to-
reduce this 1,000 that we added to make it now what? 800. So if you like, you can
Yes.
bring the 800, or you come and subtract the 200 from it.
200. Okay.
All right. So I'll put all of these things in the brackets. Then minus what? 500.
200.
5 minus 200 rather. I don't
Yes,
think
200, the depreciation.
that anything again will come for this one. So we cannot translate their total of this one at 0.4.0. Are we okay now?
Yeah.
Okay.
Okay. Let's move on. So the first part we are done. You see, sometimes the question will give you the purchase consideration in the currency of the parent. You have to do the goodwill calculation in the currency of the subsidiary. So you can see that in the statement of financial position, they are giving you investment of what? 5,000, which is for the parent. If they didn't say anything about the equivalent of that particular 5,000 in the subsidiaries statement of financial position, you have to come and what? Translate it to the subsidiaries what? Currency, because you have to do the goodwill calculation in the subsidiaries currency. So they have given us that already. If you want to try it, you can also look at it. You can see that the acquisition was done on July. So 2 times the 5,000 will give us 10,000. But if you're not giving this figure, you change the purchase consideration to the subsidiaries currency. All right, let's move on. Do you have any information about do you have any information that will affect the net asset again? I don't think so. Just before the year end, Paint acquired some goods from a third party at a cost of 800, which it sold to Brush for cash at a markup of 50%. At the reporting date, all these goods remain in the inventory of Brush. Okay, on June, Paint lent Brush 1,400. The liability is recognized at a historical rate within the non-current liabilities of Brush. Let's eliminate this before. The paint is the owner of the Brush. So can you give loan to your own company?
No.
If you have a head office in Accra, you have branch in Kumasi, will you say you are giving loan to the branch in Kumasi?
No.
No, you are just investing in your own company, so you are not giving loan. So Paint is showing this as an asset, and Brush is also showing this as a liability. What we are going to do is that Paint figure is, if you look at the loan, Paint figure is 1,400. So we subtract 1,400. But Brush figure is not in dollars, it was in D. So we are coming to ask ourselves, what is the value of the loan? What is the equivalence of the loan they are reporting in their non-current asset? They say this liability is recognized as the historical rate within the non-current liabilities of Brush. When was the loan given? When was the loan given? When was the loan given?
First June. First
June.
June.
So if you translate it, what would be the D equivalence of the $1,400?
$5,460.
5,000.
460.
Okay. So in this case, so you can see that it's 5,460, the same loan that they have over here. So what are we going to do? We remove it. You can't be owing yourself. So we subtract. Are we okay?
Okay.
So we remove that because you can't be giving loan to your own company. It doesn't make sense. The same way you can't be selling to your own company. It's just like you have customers over there. So you just send a goods to your branch. Whenever you receive goods, what do? You give it to the branch and say that sell it at this amount. Sell it at this amount. The branch will not get any profit on it. They will just sell it any amount that they have gotten. They will remit the amount to you. They are not selling at a profit. You are just giving the goods to them that, okay, my friend, send this to me. The best that you can do for the person is to give the person commission. The person cannot sell at a price that, unless the person is an African. All right. So we are done with the what? The loan. We are done with the loan C. Let's now close our net assets. So the net asset, nothing will come. There won't be any adjustment again. So let's look at the net asset at acquisition. So we have some of this. Which will give us this. I'm having 2,500. And at reporting, let's do at reporting too.
Linus.
Yeah.
Please, the PUP, won't it affect the net assets?
It is a parent that is selling. The net asset is for the subsidiary.
Okay.
So that will go to the parent. The profit on that, the unrealized profit is the parent's retained earnings. So it's to go to the parents.
Okay, thank you.
So if it is the subsidiary that is selling, it means that the unrealized profit is part of this profit over here, the 12,000 over here. So we have to remove it. But it is the parent that is selling, so it will not come here. Thank you.
Okay.
All right, so let's look at the post-acquisition profit. Is 11,800 D. Okay, so should we use all the possible ways of solving this question, or we should use maybe at least two? All right, let's come to goodwill calculation. Let's come to goodwill. The goodwill, what we do is that we ask ourselves, how much is the parent paying and how much should they have paid? So we have the purchase consideration. Or let me just put the consideration there. How much is the parent paying? They are paying 10,000 D. Okay. So the question now is, how much should they have paid? How much should they have paid? A. No. Then this question is not correct. Look at the this thing. Look at the net asset at acquisition. What's the net asset at acquisition?
2005.
Look at the NCF value. What is the NCF value?
50.
The NCF value is 5,000, isn't it?
5,000.
What can the NCF be? How can the NCF value be higher than the value of the assets? Are you getting the argument? Then maybe there will be a figure somewhere. Or I'm the one who doesn't reading. Okay. No.
Maybe one of the zeros. We are missing one of the zeros.
So maybe even the parents cannot be paying maybe that 10,000, then they are paying 12,500, 2,500, they are paying this one. No. There should be. It was someone who sent the question to me. Oh. I don't know whether the person is here. Let me check the questions again. Hey. Or this thing.
Is the return earnings?
So the return earnings should be how much?
I think it's 5,000 and you wrote 500.
It should be what? Were you the one who sent me the question? Hey, assembly. No, that this thing. Let me check if it's.
You confirm from the person and let's see.
Let me check whether I'm the one who didn't type the question well or. You got the person? It should be one of. Hey. Hey. Okay, I'm sure this will be the question now. Okay, let me check. It's the same thing. NCI.
Can't it be possible that the examiner just did it that way?
No. How can you say the value of the asset will be shared among the NCI and the parents, and the NCI share is higher than the value of the company? It doesn't make sense. So I don't know. They say the retained earnings was 500. The fair value of Brush net assets were this and this, and they say the non-controlling interest was 5,000 D. No. Or the retained earnings was 12,000 rather. Let me make the retained earnings at acquisition to be 10,000 so that we solve it the way it is. Are you okay? It will be, if you do it, it will be the same thing. So let me make this one 10,000. Okay. So let's move on. Let me make this one 10,000 so that we go. At the end of the day, it will have the same effect. All right. So where are we? We are on the goodwill. Okay. The net asset at acquisition, the total value is 12,000. Out of this 12,000, how much is for the NCI? The total value of the company at the date of acquisition was 12,000. And out of the 12,000, NCI is taking how much?
40%.
No, they have given us
5,000.
they have given us the NCF value already. So you can only use 40%
Ah.
if it is on proportion. They can say that they are using proportional method. So you
Okay.
use 40% on that. But if they have given you the 5,000, then it means that the NCF now is 5,000. What it
Okay.
means is that calculate 40% on 12,000. Let me show you something. Calculate
That's 4,800.
that is 4,000 what?
800.
But how much is NCF taking?
5,000.
5,000.
It means that they are also having 200 share of the goodwill.
Oh, okay.
That is the meaning of the fair value method. It means that the
Okay.
goodwill that we are going to get, they have a share which is relating to 200 of the goodwill. All right.
Oh, okay.
So if 12,000 NCI is taking 5,000, then how much is the parent paying for? How much would the parent be paying for?
7,000.
7,000.
7,000. So you can just subtract 7,000 from the consideration and get your goodwill. That is the portion that the parent is paying for. So this is a net asset relating to the parents. Okay. We have that will be 3,000. That is a goodwill. Another way of doing this is this. Since then the NCA portion is in the 12,000, come and add the NCA to the 10,000 to have 15,000. Then you now come and subtract all the 12,000. We are adding the 5,000 because the 5,000 is already part of the 12,000. So if we want to subtract all the 12,000, it means that we are subtracting the NCA figure also. So we'll go and add the NCA figure to the amount that the parent is paying so that you do it like that. Anyhow you do it. All right. But I hope that the one that we were taught is you add the NCI, then you subtract the total value of the net asset. You still get a 3,000.
Yes. Yeah.
All right. But you find the parent portion and how much is the parent paying. That is a goodwill. This is a goodwill at acquisition. But what did they say? Goodwill at acquisition. They said the goodwill has impaired by what?
%.
10%. So we now impair the goodwill impairments. So 10% on 3,000 give us how much?
300.
Okay. That will give us 300. So the goodwill at acquisition will be how much?
2,700.
2,000.
700.
Okay. 2,700. So this is the goodwill figure that will go to statement of what? Profit or loss. But this impairment of 300 will be shared among the parent and then the subsidiary. So what you do is that you go to your statement of financial position, then you bring the goodwill. It will be 2,700 translated at the closing rate. Am I correct? Divided by 4.0. Okay. Let's move on. All right. I hope you are done with the first part, isn't it? Let's come to the B part. Just before the year end, Pent acquired some goods from a third party at a cost of 800, which is sold to Brush for cash at a markup of 50%. At the reporting date, all these goods remain in the inventories of what? Brush. So the parents, so what will be the selling price of the goods given to Brush?
$1,002.
That would be 1,002 because the 50% is a cost. So 50% on the cost will be, let's show the workings for the parent group return is. We take the parent figure. What is the parent's return earnings? It's 4,000.
4,000.
So we take their figure, then we add anything that will be affecting it. So the profit element on the sell is what?
That's the 400.
60% of 60% of the figure.
50%. That will be the provision for unrealized profits, which the parent is assuming that they are going to make a profit of 400 at the time that they are sending the goods to the subsidiary. But at the end of the day, none of these goods were sold. So the 400 profit in the books of the parent must be removed. But at what price is the subsidiary carrying the goods?
1,002.
That would be the D equivalence of 1,002, isn't it?
Okay.
The D equivalence of what? 1,002. But inventory should be carried at what? Cost, lower of cost, and its net realizable what? Value. So what we are going to do is that we have to go and reduce the cost to what? 800. We have to go and reduce the inventory to 800. But this 800, what we are going to do is that the subsidiary is keeping the inventory at 1,200 as the equivalent of their rates. They say just before the year end. So we use the closing rate for that. Just before the year end. Just before the year end. So if they are keeping the goods at 1,200, what will be the D equivalence?
4,800.
4,600. We are not selling to them, so
800.
4,800. So the goods has to be with us. So what we are going to do is that we are going to the inventory of the subsidiary. They are having only 4,000. The inventory figure is only 4,000. Yeah, Joyce.
Please, where from the 1,002 you are talking about?
The cost of the inventory is 800, and they are selling this at a markup of 50%. So the selling price will now be the cost price plus the profit, which is the 50% on that.
Okay, thank you.
Are you okay? Okay, so 1,002 times 4. This question has a lot of problems. The inventory that they should be keeping in their figure should be what? 4,800, isn't it?
Yes.
So if they don't sell all the goods, why should their inventory be 4,000? Are you getting the argument?
Yeah.
If they didn't sell all the goods, they should have the inventory in the store. All these goods remain in the inventories of Brash. So if you are giving 800, you are going to recognize these goods at your currency equivalence, which will be 4 just before the year, the year end. So 1,002 times 4. So you have to translate the goods at the closing rate just before the year end. That is the amount of the goods that you have received. And why should it be they are having 4,000 there? It is well.
So we are supposed to subtract the 4,800 from it,
From
right?
their inventory. Then we go and add the
Okay.
800 back to the parent figure, because they're supposed not to be keeping the goods. So they are keeping it at selling price. So we will not subtract it because the goods we are not selling to them. So we assume that the goods are still with us. So we are going to remove it and now add the 800, which is the cost of the goods. Okay. So what we are going to do is that since they are also keeping the goods at 4,800, okay. So the adjustment that we are going to do right now is that we are going to subtract only 800 from their figure. We are going to subtract only 400 from their figure because we assume that the goods will also be translated at the closing rate. So what figure should we subtract? What is the profit element? We have to take the profit element from the inventory there, isn't it? So let's assume that the 800 will still be part of their listing because the exchange rate is the same, 444. So there won't be any, but whenever the time that they are receiving the goods, the exchange rate is different from the closing rate. It means that if you don't subtract, you are going to calculate exchange gain on the inventory, which should not have been on the inventory because we are not selling to them. But since the exchange rate is the same now, we assume that, okay, even if we don't subtract, the effect will still be the same. So let's calculate the profit element, which will be 400. So 400 times 4, how much will be the figure there?
1,006.
So we now subtract 1,006 from this one. So we assume that we are still keeping the cost in their figure, which the cost is 3,200 in their figure. So we assume that we are subtracting only the profit element. But I'm saying that if the exchange rate at the date of the sale is different from the reporting date, remove the intragroup, remove all the sales. Remove all the sales. You didn't sell to them. You can't be getting a gain on your own inventory. Is that the inventory belongs to the parent? So why should the parent be revaluing the inventory at a closing rate? No, it doesn't make sense. The inventory is a non-monetary item. So you remove all the sales as if there's no sales before you come and add the actual value to the parent figure. You come and add the actual cost to the parent figure. So in this case, since the exchange rate is the same, you just remove the profit element. So what we do is that we now come and translate this. If you translate this, you will still be getting